Well, there's no doubt the new bar will be promoted on places like Facebook and Twitter, and maybe there will even be a Groupon for it. But when it comes to investing in these high-profile internet stocks like Facebook and Groupon, the results may not be as successful. In this morning's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins us. We're talking about the internet stocks and why some of the new kids on the block in that arena are failing. Mike, good morning.
Good morning, Brian.
There was a lot of hoopla when Facebook went public, and a lot of people jumped in at that point. How have things turned out for people who invested there?
Right. Well, we have seen a wave of these so-called social media stocks come to market in the last 12 months or so. Recognizable names like Groupon, Facebook, Zynga, all very recognizable brands, all very popular on the web, but unfortunately that popularity hasn't translated to a lot of success despite all of the hype. We all recall Facebook just a few months ago coming to market at about $40 per share.
Very high.
Just this week we saw those shares trading below 20.
Wow.
Groupon came to market late last year at 25, and now those shares are trading at about $5 per share. So these are stocks that have lost significant value in a very short period of time. So naturally the early investors are pretty frustrated.
So the sites are very popular still, the stock's not doing so well. What is the disconnect?
Well, the popularity is certainly very important, but more important to share price is being able to generate revenue. And that's where the difficulty is coming in for these companies. I mean, we look at Zynga and Groupon, both of which have seen demand for their products fall off significantly in the last several quarters. Facebook remains as busy as ever, yet they're not necessarily generating a lot of revenue from their users. So the market's looking for more than just a good idea. It wants to see that you can monetize that idea and turn a profit.
All right, we're going to use the term older here loosely because internet stocks are not old by any means, but some of the older, more established internet stocks are still doing pretty well. What's their secret?
Sure. Well, you're right. If we look at some of these newer stocks versus some of their older peers, you see that the old hands, if you will, to the internet are doing much better. Companies like Amazon and Google have figured out how to turn that consistent profit, and as a result their share prices have risen to the point really where they're both trading near all-time highs. So you know, you look at Google, they've figured out how to leverage advertising, how to target ads to their users and create a profit that way, something that Facebook would love to emulate but just haven't figured out how yet. So just have to remember that it's early in the ballgame still for these new companies. Their stocks may at some point hit their stride, but at least for now it looks like all of the hype and buildup was a great deal more than the actual substance itself.
Well, their prices are low now. You might want to think about buying now and get in on the climb. Thank you, Mike. We appreciate you, and of course, U.S. Bank.